Money and credit. They're two of the most powerful forces shaping our economy. And let's be honest, our lives. But how do they really work? Who do they work for? And what happens when they don't? Well, in this explainer, we're going to dive in and find out.
Okay, just imagine this for a second. You're a shoemaker, and you need to buy some wheat. Sounds simple, right? But what if the farmer who grows the wheat doesn't need any shoes? Suddenly, you've got a huge problem. And that exact problem is why money was invented in the first place.
So let's jump right into how we got here. We're going to see how humanity went from that chaotic system of just trading stuff to the organized system of money we all use every single day.
That core problem with bartering, it actually has a name. Economists call it the double coincidence of wants. It's a mouthful, I know, but it just means you have to find someone who not only has what you want, but also wants the exact thing you have. Talk about inefficient.
So, to solve this, we invented money. At first, it was things that pretty much everyone found useful, like grain or cattle. Then, for literally thousands of years, we used precious metals. But today, the money in your pocket is just paper and some bits of metal, with almost no real value in and of itself. And that brings us to a really huge question. If a banknote isn't made of gold, and you definitely can't eat it, why on earth do we all accept it as payment?
Well, the answer boils down to one word: trust. Trust that's backed up by authority. We accept it because a country's government says it's legal. In India, for example, the Reserve Bank of India issues currency for the government, and the law says it has to be accepted for any transaction. Simple as that.
Okay, so we've got this government-backed money we all trust. But what about the cash you're not using for your day-to-day expenses? It doesn't just sit under a mattress. It goes into the banking system.
And this is where banks come in. And their role is actually pretty simple, but also kind of brilliant. They act as a bridge. They take in deposits from people who have extra money, the savers, and then they lend that money out to people who need it, the borrowers. The way they make a profit? They just charge more interest on the loans than they pay out on the deposits.
Now, that whole act of lending creates something incredibly powerful: credit. But as we're about to see from two very different stories, credit can be a ladder that helps you climb to success, or it can be a devastating trap.
So what is credit really? At its core, it's just a promise. A lender gives you something now, and in return, you promise to pay them back in the future, usually with a little extra on top. But its impact, it's way more complicated than that.
Just look at these two stories. They show the two faces of credit perfectly. For Salim the shoemaker, a loan was his ladder. It gave him the cash to buy materials, fill a huge order, and make his business grow. But for Swapna the farmer, that very same tool, a loan for seeds, became a trap when her crops failed, leaving her with no way to pay it back.
And this is what we call a debt trap. It's a really nasty cycle where you're forced to take out a new loan just to pay off an old one, pushing you deeper and deeper into debt. For someone like Swapna, it can mean having to sell off her most valuable asset, like her land, just to keep her head above water.
So you have to ask, why? Why did credit work out so well for Salim, but end in disaster for Swapna? Well, a huge piece of the puzzle is where they got their loans. It turns out there's a massive divide in the world of credit. See, credit sources fall into two main camps. You've got the formal sector, banks and cooperatives. These guys are regulated, they're supervised, they have lower interest rates, but they almost always require collateral, something valuable you own that they can take if you don't pay. Then you have the informal sector. Money lenders, traders, there's no one watching them, so while they might not ask for collateral, they charge much higher interest rates to cover their risk.
And if you look at the numbers for rural India, it's pretty eye-opening. While banks are the biggest players, look at that. Almost a quarter of all credit still comes from informal moneylenders, the ones who often charge those incredibly high interest rates.
But this chart right here shows the harsh reality of that credit divide. In the cities, the richer you are, the more likely you are to get cheap, safe loans from a bank. But poor households? Over half of them are forced to rely on expensive, unregulated, and often predatory informal credit. It's a huge disparity.
So, with a divide that big, what's the solution? How do you break this cycle, where the people who need help the most get the worst possible deal? Well, there's an incredible, innovative solution that's tackling this problem right at the source.
The answer, for millions of people, has been self-help groups. These are small, local groups, usually made up of women, who are literally changing the credit landscape for themselves and their communities.
And the way they work is amazing in its simplicity.
About 15 to 20 neighbors get together and start pooling their savings, even if it's just a tiny amount each week. They use that pool to give small loans to each other at a fair rate. But here's the magic part. After a year or two of doing this regularly, the group as a whole becomes eligible for a much larger loan from a real bank, and they get it without any one person having to put up collateral.
And the impact here is just huge. Yes, they solve the collateral problem and provide affordable credit, but they do so much more than that. They help women start their own small businesses, giving them economic independence. And on top of that, they become these vital community hubs for talking about everything from health to domestic violence.
This whole philosophy is summed up perfectly by Professor Muhammad Yunus, the Nobel Prize-winning founder of Grameen Bank. He understood that fair credit isn't a handout, it's a tool. It's the tool that allows millions of people to unlock their own potential and together create a development wonder.
All right, so what a journey, right? From trading cattle to community-powered loans. We've seen how money and credit can be used to build fortunes or, sadly, to break lives. So what's the big takeaway from all this?
Here's the bottom line. Making sure everyone has access to affordable credit isn't just a nice idea. It's an absolute engine for a country's development. Because when people can invest in their farms, in their businesses, in their futures, well, the entire economy grows along with them. And that leaves us with one final, really important question to think about. As our money becomes more and more digital and lending moves online, the whole system is changing again. But the core challenge, it's still the same. How do we build this new financial world in a way that finally closes that credit divide for good and ensures a fair shot for everyone?